What's up, everyone? Welcome back to the channel. Today we're tackling one of the most common questions I get asked by subscribers, and that's this: should I buy silver or should I buy gold? And with silver currently sitting at $77.10 per ounce and gold trading above $5,000, this question has never been more relevant. By the end of this video, you're going to understand exactly which metal makes more sense for your portfolio right now, based on fresh data, fundamentals, and what's actually happening in these markets as we speak. Let me start by acknowledging something important. Both metals are in bull markets. Both have performed exceptionally well over the past year. Gold is up significantly, and silver, despite crashing 36% from its all-time high of $121 back on January 29th, is still up over 138% compared to where it was trading a year ago at around $32 per ounce. So we're not talking about one being good and one being bad. We're talking about which one offers better risk-reward from current levels. Now, before we dive into the comparison, let's talk about why anyone would choose one over the other, because understanding this is critical to making the right decision for your situation. Gold and silver are both precious metals. They're both seen as stores of value, and they both tend to perform well during times of economic uncertainty or currency devaluation. But that's where the similarities end. These metals behave very differently. They have different demand drivers, and they appeal to different types of investors. Let's start with gold, because it's the simpler story. Gold is primarily a monetary metal. About 50% of gold demand comes from jewelry, but much of that jewelry, especially in countries like India and China, is actually a form of savings and wealth storage, not just adornment. Another 40% or so comes from investment demand, things like bars, coins, and ETFs, and then you've got about 10% from industrial uses and central bank purchases. The key thing about gold is that it's relatively price inelastic on the industrial side. Unlike silver, gold doesn't have massive industrial demand that fluctuates based on economic cycles. When you buy gold, you're essentially buying monetary insurance. You're betting that fiat currencies will lose value, that central banks will continue to print money, that geopolitical tensions will remain elevated, and that investors will want a safe haven asset. And right now, all of those factors are very much in play. Gold above $5,000 might seem expensive, and on an absolute basis it is. But from a monetary perspective, gold is actually undervalued relative to the money supply growth we've seen over the past 15 years. If you adjust gold for total global debt, or M2 money supply, it should arguably be much higher. So the gold bulls will tell you that $5,000 is just a stepping stone to $6,000, $7,000, maybe even $10,000 per ounce over the next several years. Now let's talk about silver, because this is where things get interesting. Silver is a hybrid metal. It's part monetary metal, part industrial commodity. And that duality is what makes silver so much more volatile, and frankly, so much more exciting than gold. About 60% of annual silver demand goes into industrial applications because of its excellent conductivity properties. Solar panels alone consumed over 25% of the entire annual global silver supply in 2024, and that demand rose again in 2025. Electric vehicle-related silver demand jumped an estimated 20% in 2025, driven by growing use of sensors and high-voltage wiring. Data centers and artificial intelligence-related technologies are consuming more silver as that infrastructure builds out. And then you've got traditional industrial uses in electronics, medical equipment, batteries, and hundreds of other applications. The other 40% of silver demand comes from investment in jewelry. And this is crucial because when silver gets hot, when it starts moving up in price, investment demand can absolutely explode. We saw this over the past year. ETF inflows turned positive after nearly 2 years of outflows. Retail investors re-entered the market aggressively once silver broke $30, and then again at $50. Even after the crash from 121, interest in silver remains extremely high. So here's the first major difference between gold and silver. Gold is steady, it's the tortoise, it grinds higher over time with relatively lower volatility. Silver is the hare, it's explosive, it's volatile, and when it moves fast. Just look at what happened in January. Silver went from around $90 to $121 in a matter of days. That's a 30+% move in less than 2 weeks. Gold doesn't do that. Gold might move 5 or 10% over months, not 30% in days. Now let's talk about accessibility, because this is a huge factor that doesn't get enough attention. At $77 per ounce, silver is accessible to almost anyone. You can buy a single ounce of silver for less than $80. You can start building a position with $100, $200, whatever you can afford. Gold at over $5,000 per ounce is a different story. Sure, you can buy fractional gold, or you can invest through ETFs, but there's something psychologically powerful about owning physical ounces of a precious metal. And silver gives retail investors that ability in a way that gold simply doesn't at current prices. This accessibility advantage means that silver tends to attract more retail investor interest, especially during periods of monetary uncertainty or inflation concerns. When regular people get worried about their purchasing power or the stability of the financial system, they're much more likely to buy silver than gold simply because they can afford more of it. And that retail demand can create explosive price movements when it kicks in all at once. Let's talk about the supply-demand fundamentals, because this is where silver really shines compared to gold. Global silver supply fell from 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024, and it remained constrained in 2025. Meanwhile, global demand reached an estimated 1.2 plus billion ounces. That's a structural deficit likely in the range of 160 to 200 million ounces for 2025 alone, and this is expected to be the sixth consecutive year of supply deficit in 2026 at 67 million ounces. Gold doesn't have this kind of supply deficit. Gold supply and demand are relatively balanced. The gold market is much larger, much more liquid, and much more stable from a supply-demand perspective. Silver's deficit is structural, meaning it's not just a one-year phenomenon. It's been building for years, and it's getting worse. Mexico's regulatory changes in 2024 and 2025 cut expected silver output by approximately 5% in affected regions, further tightening supply conditions. Now here's where it gets really interesting. When you have a persistent supply deficit, and that deficit continues year after year, eventually you run out of above-ground stocks to make up the difference. Silver has to come from somewhere. It comes out of ETF inventories, out of existing stockpiles, out of recycling. But at some point, those sources get depleted, and prices have to rise high enough to either incentivize more production or destroy enough demand to bring the market back into balance. The gold to silver ratio is another critical metric to understand. Historically, this ratio has averaged somewhere between 50 to 1 and 60 to 1 over long periods of time. During the January peak, when silver hit 121, the ratio compressed all the way down to around 44 to 1. That's extremely tight by historical standards, and it suggested that silver was overvalued relative to gold, at least in the very short term. Today, with silver at 77 and gold above 5,000, that ratio has rebounded to around 63.5 to 1. What does this tell us? It tells us that the extreme speculation in silver has been wrung out of the market. The ratio is back to a more normal historical range. And here's the thing. If you believe that silver should trade at a 50 to 1 ratio relative to gold, and gold is at $5,000, then silver should be at $100 per ounce. At 77, silver would be undervalued by about 30% relative to gold based on that historical ratio. Now, some really aggressive silver bulls will point out that the natural occurrence of silver in the Earth's crust, relative to gold, is about 17 to 1. They'll argue that silver should trade much closer to gold than it currently does. Bank of America's Michael Widmer has put out forecasts suggesting silver could reach anywhere from $135 to $309 per ounce based on historical gold-to-silver ratio compression scenarios. Those are eye-popping numbers, and while I think they're possible in an extreme scenario, I also think they require some pretty specific conditions to play out. Let's talk about the macro backdrop, because it affects both metals, but in different ways. Markets are currently pricing in roughly 60 basis points of Federal Reserve easing by year-end. Weaker U.S. economic data has shifted expectations toward easier monetary policy. December retail sales unexpectedly stalled, and the GDP control group fell 0.1%. When the Fed cuts rates, both gold and silver benefit because the opportunity cost of holding non-yielding assets decreases. But here's the key difference. Gold benefits from rate cuts, primarily through the monetary channel. Lower rates mean weaker dollar, mean higher gold prices. Silver benefits from that same channel, but it also has the industrial demand component. If rate cuts stimulate economic growth, that's good for industrial demand for silver. If rate cuts fail to stimulate growth and we get stagflation, that's good for silver's monetary demand. Silver basically wins in multiple scenarios, whereas gold primarily wins in the monetary debasement scenario. Safe haven demand has been fueled by a rotation away from dollar-denominated assets amid growing concerns over policy uncertainties in Washington. Questions about Federal Reserve independence, geopolitical tensions, trade disputes, all of this drives investors toward precious metals. And while gold gets most of the attention in the financial media, silver often outperforms gold on a percentage basis during these risk-off periods, precisely because it's more volatile and more leveraged to investor sentiment. There's also an important development that most investors are completely ignoring. Russia is implementing an ongoing multi-year plan to accumulate $535 million in silver. This represents the first major central bank to openly add silver to reserves in the modern era. Central banks around the world hold thousands of tons of gold in their reserves, but silver, almost none. If Russia's move signals a broader trend of central banks diversifying into silver, even in a small way, the price impact could be enormous because the silver market is so much smaller than the gold market. So let's get to the million-dollar question. Which metal should you buy right now? Here's my honest take. And I'm going to give you several scenarios because the right answer depends on your situation, your risk tolerance, and your investment time horizon. If you're conservative, if you want stability, if you're primarily concerned about wealth preservation and you can afford the higher per ounce price, gold makes more sense. Gold at 5,000 plus is still a solid long-term hold. Most major investment banks are forecasting gold to move higher over the next few years, with some targets in the $6,000 to $7,000 range. The volatility is lower, the liquidity is higher, and you're basically buying insurance against monetary chaos. If you're aggressive, if you can handle volatility, if you're looking for potentially higher percentage returns, and you don't mind the roller coaster ride, silver at $77 offers much more upside potential. The supply deficit, the industrial demand growth from EVs and AI, the potential for investment demand to surge, and the attractive gold to silver ratio all point to silver having more room to run on a percentage basis. Here's my personal approach, and this is what I recommend to most people. Own both, but weight your allocation based on your risk profile. A conservative allocation might be 70% gold, 30% silver. A moderate allocation might be 50-50. An aggressive allocation might be 30% gold, 70% silver. The key is to have exposure to both metals because they complement each other. Gold gives you stability and monetary insurance. Silver gives you leverage and industrial exposure. From a timing perspective, I think silver at 77 offers better risk reward than gold at 5,000 plus right now. Silver is down 36% from its peak. It's testing support levels. The weak hands have been shaken out, and the fundamental backdrop with the supply deficit and growing industrial demand is incredibly strong. UBS is forecasting that spot. Silver will return to the $100 threshold by next month. JP Morgan sees silver averaging $81 per ounce for all of 2026. Gold could certainly move higher, and I'm not bearish on gold at all, but the percentage gains from here are likely to be more modest. If gold goes from 5,000 to 6,000, that's a 20% gain. If silver goes from 77 to 100, that's a 30% gain. If silver recovers back toward its January highs near 120, that's a 56% gain. The math just favors silver for aggressive returns. Now, there are risks to consider. Silver's industrial demand exposure means it could get hit hard if we have a severe recession or if industrial demand from solar and other sectors declines more than expected due to high prices. UBS strategists have noted that with more than 50% of demand linked to industrial applications, elevated prices could result in reduced industrial demand over time. That's a real risk. Gold doesn't have that same industrial demand vulnerability. Gold's demand is more stable, more predictable, so if you're worried about economic downturn, gold might be the safer bet. But remember, even in recessions, central banks tend to ease monetary policy aggressively, which is ultimately bullish for both metals. Here's my bottom line on the gold versus silver debate. Both metals belong in your portfolio if you're concerned about currency devaluation, inflation, or geopolitical instability. But if I had to choose one metal to overweight at current prices, it would be silver. The combination of supply deficit, industrial demand growth, attractive valuation relative to gold, and the potential for explosive investment demand makes silver the more compelling opportunity right now. Silver at 77 is down significantly from the peak, which means you're buying after a correction rather than chasing momentum. The support levels around 75 to 77 appear to be holding. And if silver can stabilize here and start working its way back toward 85 and then 100, the percentage gains will be substantial. For those of you who want to play it safe, do the 50-50 split. Put half your precious metals allocation into gold for stability and half into silver for upside. That way you're positioned for whatever scenario plays out, and you're not trying to perfectly time which metal outperforms when. All right, that's my take on the gold versus silver debate for 2026. If you found this comparison helpful, do me a favor and smash that like button. And let me know in the comments which metal you're buying right now. Are you team gold, team silver, or are you diversifying across both? I read every comment, and I'll respond to as many as I can. If you're not subscribed yet, hit that subscribe button and turn on notifications so you catch my next update. I'll be tracking both of these metals closely as the year progresses. Thanks for watching, and I'll see you in the next one. Sonnet 4.5.